Hi, I'm Greg Hunter, and welcome to USAWatchdog.com. Today's guest, Yale professor Robert Shiller. Now, you may remember several years back, he wrote a monster book called Irrational Exuberance. It predicted the current housing crisis that we are now 5 years into. He's also the Shiller in the Case-Shiller Home Price Index. He's one of the founders of that index. We're going to talk to him all about housing and also his latest book called Finance and the Good Society. Dr. Shiller, thanks for being on USAWatchdog.com.
My pleasure.
Let's talk a little bit about the latest Case-Shiller report. I don't want to talk about the detail, the minutia of it, but it got reported as an increase in housing prices in April, which that is true. But what really got soft pedaled was that year over year in the 10 and 20 city index, 1.9% in the 10 city index, a little more than 2%. Roughly, housing prices are still down year over year in the Case-Shiller index. Have we hit a bottom in the housing crisis?
Well, we did hit a bottom in 2009 when the Obama plan started to kick in with homebuyer tax credit, and they were going up for a while, but then they fizzled again in 2011, and they just started to come back a little bit. So it's been bouncing around, and it's hard to predict what will happen next.
Well, in April, you said, and this was an astounding statement, that housing may not recover for a generation in our lifetimes. And can you expound on that a little bit, that housing may not recover in our lifetimes? That's an awful bold statement, especially coming from someone who studies this like you did.
Well, by recover, I meant recover their values at the peak. That was the biggest bubble in U.S. history, and it might well not repeat. I'm thinking of other examples of major bubbles. In the 1920s, we had a major bubble in southeastern land prices, notably Florida, so it's been called the Florida land bubble. Started crashing in 26. It didn't come back for another half century. Florida just didn't have another boom for it. And similarly, Japan had a major bubble in housing prices in the 1980s, peaked in 1990. It's been going down ever since. So there is historical precedent for these bubbles not to be repeated. I'm not saying that I know the future, but it certainly seems plausible to me that we don't just go back up to our 2006 levels.
Let me ask you this, though. I mean, right now it's pretty widely known. Many different people, Peter Schiff, former Treasury Deputy or Assistant Treasury Secretary Paul Craig Roberts, many people say, listen, the Federal Reserve is suppressing interest rates, and that suppression is ending up in the mortgage market. What happens to interest rates when the Fed will no longer or can no longer suppress rates? In other words, we won't have a 30-year at 3.5%. We might have a 30-year at 6.5% or 7%. What happens to home prices if interest rates go back to 6.5% or 7%?
Well, that's a good question. Remember, we've had much higher mortgage rates than that. Around the time that Paul Volcker became Fed chairman, we had mortgage rates over 15%. You kind of wonder how anyone afforded to buy a house in those days. Well, it was also a time of very low home prices, and I think there was a causal link. So extreme movements in the mortgage rate can affect home prices. Small movements don't seem to have that much of an effect. But if they go up, if interest rates go up, and by the way, it's not just the Fed. If the government doesn't support Fannie Mae, Freddie Mac, FHA, who are all in trouble these days, if they cut them off, that will make it even harder to get a mortgage. That's why there are a lot of long-term doubts about home prices right now.
If interest rates only go up to 6 or 7%, doesn't that mean that housing prices are going to take another cliff dive?
I don't think that home prices are reliably predicted by anything. We have not been able to predict these bubbles with any accuracy. But I think it's absolutely right. If mortgage rates go up, and if the government doesn't support mortgages as much, that is a negative indicator. And there's another thing, which is the mortgage interest tax deduction, which the government may curtail in an effort to close the budget deficit.
that if that happens, so that's why you're not really bullish on housing. You're saying, that these are some of the factors that may play a part of it not recovering for a generation or a lifetime.
Yeah, I think that there's another factor. There's lots of factors. Another factor is that in the aftermath of this crisis, Americans don't seem to be so keen on housing as an investment. And I think that they're more willing to rent, and there's maybe more of a preference for the city rather than the suburbs that's developing. It's hard to say where that's going either. So if people don't really want houses, that's not going to bode well for their prices.
Well, if housing doesn't come back for a lifetime, as you say, possibly, doesn't that mean the banks may have a hard time recovering, the ones that are sitting on all this real estate owned and all these mortgage-backed securities and all these houses? Doesn't that mean the banks may have a hard time recovering if the overall market doesn't recover?
Well, this is the dark scenario that we're talking about. So much thinking is based on the wish or hope that home prices just take off. That would, it seem, to solve everyone's problem. The underwater homeowners who owe more on their mortgage than their homes are worth, they'll feel happy again. The banks who are, sitting on mortgages that may cause real problems for them if they default. Maybe they won't default. Maybe everything will come back. We're kind of in a holding pattern waiting for that to happen. But this crisis is already 5 years old, and it hasn't happened yet. That's because everyone's waiting and hoping. They're not spending money. They're not feeling flush and optimistic. Their animal spirits haven't come back. And I'm not sure how to predict when it will come back.
I was in your office in 2007. I sat right about where you were sitting, and you were sitting at your desk. And I asked you if the housing crisis, this is October of 2007, and I said, if the housing crisis was a baseball game, what inning would we be in? And you said, and I said the third, and you said, oh, no, the first. So I'm going to ask you again, if the housing crisis, which is now 5 years old, what inning, and it was a baseball game, what inning would we be in?
Maybe we're in the fourth.
We're in the fourth.
Yeah, we've moved a long ways.
This housing crisis was the biggest in history, and it involved a global housing boom, and now we're having a housing bust. So if the average housing crisis lasts 10 years, top to bottom, the first 4 years is the worst, how long could this one last? I mean, this was the biggest, this is the mother of all housing booms and the mother of all housing busts. So the average, it's got to be way more than the average. Could it be 20 years and the first 10 years are the worst?
It could be 20 years. I remember the Florida land bubble was the big land bubble in the U.S. We didn't have, there was a post-World War II boom, but that was because of the war, I think. After that, there wasn't anything happening for decades. So it's entirely plausible. But there's the other side of it. I wish I was more definitive in my forecast. The other side of it is we're seeing booms in some cities. For example, Northern Europe. France is going up fast. London is going up fast. The Scandinavian countries Norway looks just crazy, the way the boom is proceeding. So what's happening? Well, one theory is that, people in Europe are worried about the European crisis and they want to invest in something solid and something non-financial. So a home sounds like the thing to do. So that could be the psychology that's tipping things, and it could happen here. Another thing that's happening in the U.S. is we're getting more foreign investors coming in buying homes in the U.S. And that's something that could pick up as the rest of the world gets anxious. And that could start a snowball effect that would bring on a U.S. home price boom.
But there have been charges of LIBOR being rigged. And there's executives at Barclays Bank have stepped down, allegedly because of it. And if interest rates are being suppressed not just by the Fed, but globally, doesn't the housing market lose a lot of steam if mortgage rates rise?
Well, one thing that strikes me is that we haven't seen an overshooting of home prices. After a bubble bursts, sometimes prices go way below their historical average. But it looks to me like we're just kind of back at normal. We never overshot. Same thing with the stock market. The stock market was extremely high in 2000. It came way down. It bounced up and down again, but it hasn't really gone. We never saw really low price earnings ratios. So we haven't had our catharsis, and that could be coming. I'm not predicting it, but it could be coming.
Another downward leg in housing.
That's right. And it could be brought on by a European crisis that gets bigger, and weakness in Asia. It's an uncertain. I'm not being negative. What I'm saying is that a lot of people have the mistaken impression that we must be at a bottom now, and the only question is when will go up. And I think that's a mistake. It could go up, and we could see a big boom in the next 5 years. Who knows? But I'm thinking that there's also the risk of substantial further drops in home prices.
Okay. In your book, Finance in the Good Society, brand new book that's out. I can see people can see it right here, Finance in the Good Society. You talk about people are hostile towards financial capitalism. Is that because so many people lost money in housing and saw these bankers get bonuses while, millions of Americans were thrown out in the street?
Well, that's certainly a factor. We've seen the development of Occupy Wall Street, which is a hugely important movement that reflects the disaffection of many people with the financial community. Reactions to Occupy Wall Street, though, are not uniform. They tend to, there's lots of people who are repelled by it, too, and lots of people work in the financial community, and they're not going to be so attracted to these views. So I don't think that we're necessarily so hostile to financial markets. But I think there's enough hostility that it was time, I thought, for me to write a book that evaluates the anger and thinks about what we should do next.
Shouldn't we take some of these banks to receivership, protect the depositors? The bank will reemerge as a new entity without debt. Shareholders and bondholders will take a hit. Shouldn't we take and start writing off this debt and find out what our capital base is?
Well, these banks might be in more trouble than they appear. We saw, we had these stress tests a couple of years ago that proclaimed that they were safe, but the stress test didn't look so prescient. Europe has had stress tests, and then we see European banks in trouble. So these problems have a tendency to reveal themselves slowly. And I think that we may well have more bank failures. I'm not, however, announcing my analysis of their balance sheets, which I haven't done.
But there's a good shot.
History suggests that this might not be over.
And you're saying that history suggests there's a good shot at some big bank failures on the horizon. Is that correct?
Yeah, although right now the government doesn't want to let them drag everyone down. So the procedure that, not just for banks, but for any financial corporation that is in Dodd-Frank, is a procedure that will have a bridge bank or a bridge financial institution put in place to keep doing the business, so that people who have deposits there or have other business arrangements with these financial institutions won't see a huge crisis. That's why when we say, yes, banks might fail, but it won't be the kind of, and other financial institutions, it won't be, if this system works as intended, it won't be such a severe failure as to make people worry. And we still, by the way, have deposit insurance on accounts at banks in the United States, and I expect that to be upheld and to be. So it's not something that you should, as an individual, worry a lot about now.
If there's war with Iran and Syria, what do you think happens to the housing market?
Oh, that's an interesting question. I remember, I've been doing housing prices for a long time, and it was in the early 1990s when we had the first Gulf War, and we saw home prices drop right then, right when the war was starting. I think the wartime panic can depress home prices. People don't think now's the time I'm going to go out and buy a house if there's a war brewing. And
so
first Gulf, Saddam Hussein gave some very threatening statements that, terrorism might take off. And that really made people want to stay home and not do anything. But, it ended pretty quickly. And I think, these things are all unpredictable. So we could have a crisis in the Gulf with Iran, and it could end in 6 months, and we'd be back to the races.
But initially, if there's war in Iran or Syria, I mean, a good, shutting down the Strait of Hormuz, a shooting war, Israel attacking Iran, Iran attacking Israel, whatever. You're saying that's negative for housing prices, right from the get-go.
Well, it's negative for a lot of things, not just housing prices. The awful thought, if you look at history, there have been a lot of wars in history. And I guess we can't be others. And the war in the Middle East is a possibility. And it would be disruptive of the entire world economy, not just the housing market.
Dr. Shiller's latest book is called Finance and the Good Society. Dr. Shiller, thank you for being on USAWatchdog.com.